The S&P 500 just set a new all-time high recently, north of the 7,000 level. And I bet many of you watching this are thinking, that's it, the market's at the top. Time to sell everything and sit on cash. Here's the problem with that thinking. You're letting fear dictate your investment decision instead of data. Over the last 100 years, the S&P 500 has experienced a drawdown of 10% or worse in 2/3 of all years. You would have seen a 5% correction in 94% of all years. But here's what most people miss, which don't mean you should avoid investing at highs. In fact, BNY Mellon's research shows that forward returns after new all-time highs are higher on average than returns following other days. So before you hit the panic button, let's look at what the data really tells us about investing when markets are at their peak. Let me give you some real numbers that might surprise you. When we look at the modern era, the picture is very different from what fear mongers want you to believe. While it is true that a 10% drawdown happens in about 2/3 of the years, and a 5% correction happens in 94% of the years, those numbers are heavily skewed by the Great Depression and World War II era. But here's the kicker. The data from post-World War II tells us that frequency is lower than those scary lifetime averages. Plus, only 1 in 4 years experience a 20% bear market drawdown. And remember, we are talking about intra-year drawdowns, not end-of-year losses. The S&P 500 reached 39 all-time highs throughout 2025 alone. That's the 5th most all-time highs in a year since 2000. The lesson: yes, volatility happens, but assuming the market will crash just because it is at an all-time high ignores decades of evidence showing that highs often leads to more highs. Now, here's where it gets really interesting for active investors. Even though the market is near all-time highs, some serious respectable names are still deep in the negative territory, and that could represent massive buying opportunities. Take Microsoft, for example. The shares closed over 27% below their peak from October. That's a tech giant in bear market territory, while the broader index is hitting records. It is not just Microsoft in early 2026. The information technology sector entered correction territory, closing 11% below its October peak. Meanwhile, as of April 22nd, Abbott Laboratories hit a 52-week low, and major semiconductors like AMD and Intel experienced notable declines in March. But look at them now. What does this tell us? Market highs don't mean everything is expensive. There is dispersion, meaning while some stocks are overvalued, others are potentially undervalued and offering entry points. This is exactly the kind of environment where disciplined, selective investors can find quality companies at a discount while everyone else is paralyzed by fear of the market top. So what should you actually do when markets hit all-time high? First, embrace the momentum. Wealth management research confirms that all-time highs in stocks are typically followed by more all-time highs. That's not speculation, it's backed by decades of data. Second, use dollar cost averaging instead of trying to time a pullback that may or may not come. Spread your investments over time. This removes psychological pressure and reduces the impact of short-term volatility. Third, focus on time in the market, not timing the market. The probability of experiencing negative returns following market highs decreases significantly as your time horizon extends. And finally, practice strategic diversification and systematic rebalancing. This helps you lock in gains from winners while staying aligned with your risk tolerance. Bottom line, the data doesn't support sitting out when markets hit new highs. History shows that staying invested with a disciplined approach beats trying to predict the top every single time. So stop letting fear-based headlines dictate your portfolio decisions. Stick to the plan, follow the data, and remember, time in the market beats time in the market every time.